Disclaimer: the following video was shot without removing the orange lighting filter, so the overall picture tint is around 50 shades to Donald. It was unintentional. Next time, it will be great again. Enjoy.
Hi, I'm Lauris Bočs, and you are watching the video commentary to my article, Property Right Limitations Within the Fiat Monetary System of the European Union. As I already mentioned, I'm Lauris Bočs, and I'm a third-year PhD law student at Riga's Strategic University. The video commentary is made in relation to my published article in the proceedings of the International Multidisciplinary Scientific Conference SGEM 2017 in Vienna, Austria. Since the topic of money and monetary issues is rarely covered in European legal research, yet my doctorate thesis is about the financial sector of the European Union, its problems and possible solutions. I'm highly interested in providing the research outcomes through as much media channels as possible to reach a broader audience and actually establish a ground for legal research on financial rights, not just in Latvia, but also in the European Union. Hence the participation in the SGEM conference with the presentation and the submitted article, and also the published articles supplementary materials such as the recorded audio article and also this video commentary. I choose mottos for all my audio articles as well as the video commentaries I do, and for this video commentary I chose a quote from the famous economist Friedrich August von Hayek. The system of private property is the most important guarantee of freedom, not only for those who own property, but scarcely less for those who do not. The topic of the European Union's monetary system by itself is not of a pressing importance in legal research per se, but what is of pressing importance is the juristic ignorance relating to that topic, which has consequences within the most basic political and judicial acts of government relating to property rights of EU residents. Many legal and also economic researchers, not to speak of people in other research fields in the humanities, are quite unaware of what fiat money is, how money is related to public and private banking, and what double entry accounting has to do with it, as well as how actually double entry accounting works in the first place. So with the help of the published article and the supplementary materials like the audio article and this video commentary, I would like to shed some light on these issues, which could be helpful not just for future legislative work, but also to help actually advance sustainable development in the economy. Fasten your seatbelts, ladies and gentlemen. Here it goes. Even though my first profession is accounting, I find it a bit difficult to explain to legal scholars and even economists double entry accounting operations and their practical implications, because at best people usually can just read a balance sheet, which is just a representation of the results of double entries. So the best way to explain in layman's terms would be to actually use visual representations such as pen and paper. So I made an improvised balance sheet on a paper for assets and liabilities. I hope you can see it fairly clear. And that balance sheet is for a legal entity, well, fictional of course, and I will show how double entry accounting operations affects that legal entity. So let's suppose the balance sheet represents a newly founded company, and in simple terms, the asset column represents the values or monetary values of the company, and the liability column represents the sources for those values. So, for instance, if the company's shareholders would provide 100 euros for the new company, you would write in the liability column plus 100 as capital, and a position of capital. So 100 as capital. And in the asset column, you would write 100 as money, or let's say money in the bank account. Bank account. So you have money in the bank account, which comes from 100 euros from the shareholders. So the company now owns 100, but the source of that 100 comes from outside, and now the company is liable to the owners for that 100 euros. So now the money is in the company's bank account, and the money can be spent. And the company has basically two options for spending that money. Either they transfer the money into a different asset. For instance, they buy a computer, which would mean that the asset column still has 100, but now it would go to a different position. Let's say the position would be called IT equipment. So the 100 euros is still there, but the 100 just went from the money bank account to the IT equipment. And the other option for the bank to spend the money would be to actually just use the money for, well, trivia and write off the money. So, I don't know, they buy just essentially pens. They buy just pens, simple pens for 100 euros out of no particular reason. So they spend the money, which would mean that the money is gone, but the money has not been transferred to anything. Now, let's suppose that during that particular taxation period, that was all the transactions they had, meaning the next balance sheet would look like this. So this was the first year, or the first balance sheet, and the second one would look like simple zeros. So now you would have in the second a 0 and a 0. The 0 because the money is gone, and the 0 in the liabilities because the spending was 100 euros of losses. And if you have no incomes whatsoever, that means you have 100 in losses. And the losses are buffered by the capital provided to the company. So now the company had to actually just use the money and use the capital to just make up for the losses. So now they have zeros in the balance sheet. Let's suppose during that year when they have the zeros, they have one client. And now the one client is receiving some services from the company for 100 euros, just for simplicity's sake. So now the bank account doesn't change yet. The company writes the client in an invoice, and the invoice is for 100 euros. At that point, the balance sheet changes, and you have in the assets column 100 euros in the position as debt, or basically claims for payment. And in the liabilities, you have plus 100. Let's say they didn't have any expenses whatsoever and no further income, so that year they make a profit of 100. So the liability column would have 100 as a profit. So now the second one is 100 and 100 in both columns. Yet the difference is this. Suppose that the client received the invoice, but he didn't pay. Now, it doesn't affect the balance sheet. The balance sheet is already with 100 on both sides after the invoice has been made. But in such a case, they don't have actual money, meaning they wouldn't be able to go, let's say, and buy another round of 100 euro pens. They have to actually wait for the payment to get into their bank accounts so they have actual money. So after they get the payment, the asset and liability column doesn't change in total numbers, but the basic position of the numbers changes, at least in the asset column. So the asset column has the position for bank account again. And now, when the money is received, double entry accounting provides you with the operation of actually switching the 100 from the position for the claims for payment to the position for bank account. Now, physically, only at the time when the bank account received the money did the company actually get the money. But the 100 were already there in the company's balance sheet. It's just a matter of practicality when you can really use the money that you supposedly have. So at the time they received the money, they can actually use the money physically. So after all of these operations, the last balance sheet would be like this: plus 100 in the bank account, just the same as before at the start of it all. Yet in the liabilities column, you would still have plus 100 as a profit, not as capital anymore. Or let's say if that would be the next year, then the 100 would be just a profit from last year. But still, it hasn't converted to capital automatically. It's still a different position within the liability column. But for the asset and liability column in general, it means that the numbers are the same. But only at the last time when they received the money, they actually could use the money. They could use actually as a tool for payment. So now let us check a simplified accounting version for a lending operation by a commercial credit institution, i.e. a bank. The loan contract says that the client gets a loan of 100 euros, for instance, which he needs to repay with interest. The bank's balance sheet would look similar to that of the company in the second version, where you had plus 100 as claim for payment. So you have a claim for payment, just as it was at the time when the company wrote its invoice. And for the bank in the liability, it wouldn't have anything in the capital, it wouldn't have anything in the profit, it would have it in a position of for the actual client's bank account, which most of the time is called, so let me just position for deposits, or demand deposits most of the time. Demand deposit by the client. So you have 100 euros as the claim for payment and 100 euros as the actual bank's obligation to pay the client. Now, the funny thing is about a bank's lending operation is this. Whereas at the time when the company had the claim for the 100 euros, it wasn't able to actually do anything with any payment whatsoever. The bank, on the other side, at this point has at least practically fulfilled its obligation, because at this point when the bank writes in that the bank has obligation to pay the client already sees this number in his bank account. So essentially at this point, when this is written into the accounting ledger, the bank has provided the client with money. Even though, as you can see, the bank has not anything to do with the actual money position for the assets. The only assets they have is, well, newly created assets as the claim for a payment from the client, and they created new liabilities to pay the client. The only difference is, even though this could be considered just as a promise to pay, in practical terms, this has been already enough for the client to go into his bank account and basically make whatever payment he wishes for the 100 euros, because it's already there. Now, where did that money come from? Essentially from that operation that you just wrote in. We did it with pen and paper. They do it with a digital entry into the accounting ledger. But the difference is just in terms of technicalities. The principle still applies that 100 euros was just created out of nothing. That is why fiat money is being called that way, because it represents let it be, something that just becomes something out of nothing, i.e. ex nihilo. So the paper on the research I've done is essentially about this money creation aspect within the banking sector and in the whole monetary system in general, because that is how actual non-cash money is created most of the time, through double entry accounting. The central banks do double entry accounting as well. So the reason why that is important is simple. If you have private institutions that have a private profit-seeking motive and could basically making loans, you would like to have them, let's say, contained within some certain limits. Now, you have those limits definitely in terms of capital requirements, liquidity requirements, and capital allocation requirements, and for the efficiency of transfers and payments. But you don't have anything whatsoever in terms of the total money supply, and you don't have anything whatsoever related to the loss of purchasing power of money. So the interesting thing is, if you have a, let's say, property as a real estate, for instance, and someone were to actually deteriorate its value by some form of action, it would be considered as a loss to you and basically providing you a claim, whether for reimbursement or compensation or whatever. But when you look at the money or monetary system of the European Union, or basically any monetary system nowadays, you don't see anything that's related to the protection of the purchasing value or the purchasing power of money. So why is this important? I wrote the paper for the conference, and also I noted that in my presentation when I spoke at the conference, that every salary earner basically has their property rights violated when inflation or the loss of purchasing powers occurs. So basically, when a wage earner, a salary earner, gets his income with an absolute number of, let's say, euros, but those euros have a relative purchasing power, you have a risk of actually losing out on the money. Transactional systems are merely technical issues and barely related to financial rights of any sort, so my research is limited in terms of technical solutions for digital operations, because those are solvable according to determined needs. The determination of those needs is what my research is all about, and the biggest issue is related to the dichotomy of time spent versus money earned. Time is finite, money is not, so inflation poses a risk for the reimbursement of finite time resources of active income earners, such as wage earners, specialists, etc. So the paper has 6 theses that I made, specifically addressing the property rights issues that I see, and one of those is specifically related to the purchasing power of money. And even though I do not go into detail whether or not inflation is actually legally needed, as far as I can tell it's not, but since it occurs, the biggest and, well, I suppose the most needed action is within national sovereign jurisdictions, where you still have the inflation occurring particularly to that economic region. So one of those methods I would suggest to use, or actually to implement, is related to hedge mechanisms against inflation in a way that would contribute to the lost purchasing power of salaries and wages, or any other active income. And the way to do that is a technicality, so I just made some examples, but those are not exclusive. They might as well be much more or much less, depending on how you actually look at things. But one of those biggest that I see fit is that actual national jurisdictions can make up tax credits, since they make their own tax laws under the umbrella of the EU, of course. You have the possibility to actually provide tax credits according to registered or actual inflation measurements. Because if you take any sort of inflation measurements for the EU, you wouldn't get an average that would be fairly particular, attributable to any concrete nation. But if you have the nations do it themselves, they can actually determine whether or not they are, let's say, in an inflationary period, and whether or not they have the options to actually make some form of hedge against it. But the reason why I state in my paper that the way to do it would be by EU directive is simply because the directive would actually make it obligatory for all EU nations to do something about it. The aim would be the same. Now, you could have different solutions for that problem, which might be in one case tax credits, in another one it might be just some public service benefits that you could obtain. You might as well just provide some way of transport benefits or public transport solutions to people who actually earn wages and who lose their purchasing power, or their money loses purchasing power rather, and you can actually compensate them. Now, why would that be important for a nation? Most of the time people look at minimum wages as a somewhat of a solution, when it's actually nothing of a solution. It just makes numbers up. Those are just numbers, and if you look at the past 20 years, you probably can see in all EU member states minimum wages just rising And of course, you can say with that you had an increase in living standards, but most of them are not related to the minimum wage. They're just related to the technological developments that occurred during that period. And so if you have a basic hedge mechanism, something that tells people whether or not you earn 100 euros, 1,000 euros, 100,000 euros per year, you will still get every benefit of a €1 that you earn. So one thesis I wrote, I would like to actually read it, because it essentially just states what I intended with the paper. And that would be that the author suggests an option of establishing a fiat money system within the EU by a directive, according to which member states need to establish hedge mechanisms against inflation by, for instance, tax credits, public service benefits, or other fixed value measurement options. And the reason is simple. If you have money that's just a legal tender, a nominal out of law, but that law doesn't say, or any related law doesn't say anything about that nominal being a fixed value statement, a measurement of a fixed value, you need to have the ability to actually provide that potential value in some other way. Now, if you have the European Union with its euro currency, and everybody knows that the euro currency loses its purchasing power every year, you still need to have the issue of property rights addressed in every nation, because the purchasing power of that money is property of everybody who actually obtains that money, so at least legally. So if people get money yet they don't get the full potential of the purchasing power, it creates a true peril of economic problems. And the biggest problem is that private property has not been respected in a system of law. So money having nothing to do whatsoever with any commodity, but just being backed by an act of law, since fiat money is just that, something that is made by law, legal tender. In that case, you can also make any hedge mechanisms you would see fit, because it's the same decision-making process, it's the same monetary economic decision-making as with legal tender issue. Now, when you have EU euro currency member states with the same currency, you still have different inflation risks in those particular regions. And to have a EU directive that actually addresses or allows the regions to address their inflation particular to their circumstances is a rather simple solution that seems to actually address the problem of inflation fully, which means that in one case where you have inflation basically deteriorating the purchasing power of EU residents' money, you have a certain system for them to actually still get the full potential out of it. Let's say they could have free public transport, or a limited access to free public transport, or they could have limited access or additional access to some free benefits from public institutions. It doesn't really matter how you do it. The reason to do it is just simple. Inflation deteriorates the purchasing power of money, and that is essentially a limitation or an infringement on property rights for those EU residents who earn money, who actually need to spend their time to earn money. So one of those ways would be to actually have a EU directive placing the member states in an obligatory position to actually create hedge mechanisms against inflation, because inflation is not necessarily related to law. It usually is stated that inflation relates to the market forces in a way, but you still have the ability to actually compensate those forces within law, within the political decision-making process, which in the first place needs to actually understand how money works and where it comes from. And I hope with this simplified example for the double entry accounting operations, I have provided you at least somewhat of clarification on how this needs to be addressed, so that it doesn't pose a risk for the future of our monetary system. Because nothing, when it loses its value, nothing can lose its value endlessly. At one time or another, you will have a currency that isn't worth anything. If you look at any statistics relating to, let's say, the purchasing power of the US dollar, you can clearly see that in the past decades it has lost tremendous purchasing power. So we in the European Union are able to actually look into the past to make our future better. It's just a matter of whether or not we do that. So I hope I had the needed points to actually get the message across and to actually provide the audience not just with at least simple or primitive comprehension of double entry accounting and fiat money creation, but also with possible solutions for the determined risks. I hope this was useful to establish at least a basic understanding of double entry accounting, its relation to fiat money creation, and the possible solution for hedging against inflation within the EU member states. With that, I have concluded my video commentary, and I say goodbye till next time. But what is of pressing importance is the jurisdiction.